It's hard to breathe, but that's alright. Hush.
Now moving on to the distribution schematic, is in essence the distribution schematic works in the opposite way of the accumulation schematic I was spoken about in the last video, but with just slightly different terminology. So in phase A, the first phase occurs when an established uptrend starts to slow down due to decreasing demand. Now the preliminary supply to the PSY suggests that the selling force is showing up, although still not strong enough to stop the upward movement. Now the BC, so the buying climax, is then formed by an intense buying activity, and this is usually caused by inexperienced traders that buy out, which is pretty much emotions, right? Next, the strong move up causes an automatic reaction, so AR, as the excessive demand is absorbed by the market makers. In other words, the composite man starts distributing his holdings to the late buyers, and then the secondary test ST occurs when the market revisits the BC region, so the buying climax region, often forming a lower high. Now moving on to phase B of a distribution, it acts as the consolidation zone, so the cause that precedes a downtrend effect. Okay, during this phase, the composite man gradually sells its assets, absorbing and weakening the market demand. Usually the upper and lower bands of the trading range are tested multiple times, which may include short-term bear and bull traps, and sometimes the market will move above the resistance level created by the buying climax, resulting in an ST that, or secondary test, that can also be called as an upthrust, so UT. Okay, so phase C, in some cases the market will present one last bull trap after the consolidation period, and as we discussed on accumulation, it's a bear trap, but on this one it's a bull trap, and then it's that's called a UTAT, or also known as a upthrust after distribution, and it is basically the opposite of an accumulation spring. Now moving on to phase D. The phase D of a distribution is pretty much a mirror image of the accumulation one. It usually has a last point of supply, so the LPSY, and in the middle of the range, creating a lower high. From this point, new LPSYs are created, either around or below the support zone, and then an evident sign of weakness, SLW, appears when the market breaks below the support lines. Okay, so lastly, moving on to phase E, the last stage of a distribution marks the beginning of a downtrend with an evident break below the trading range caused by a strong dominance of supply over the demand. So that's pretty much it when it comes to the distribution side of things of Wyckoff. Like I said, this is a quick video explaining what they are, and in the separate videos we'll actually be going into how to identify them, but I'm going to be explaining does it actually work in the next video, and just some questions, and I'm also going to be throwing in a 5-step approach. I'm going to be going into that more bit more in depth, right? So yeah, thank you for watching guys, and I'll catch you on the next one.